Okay, we are going to work through a few problems related to short-term liabilities. And short-term liabilities are liabilities that are due or have to be paid within 1 year. So the amounts the company owes that have to be paid off before the end of the next year. Okay. So the first one we're going to look at is a warranty liability. When companies sell products with a warranty, they need to make sure they record a liability for that warranty when the product is sold. The reason we have to do that is because we want the expense incurred along with the revenues earned in the same accounting period. For example, here on December 1st, Bruni Company introduces a new product that includes a 1-year warranty on parts. In December, 1,000 units are sold. Management believes that 5% of the units will be defective and that the average warranty cost will be $90 per unit. As of December 31st, we need to record the amount of warranty expense they incurred in the same accounting period as the revenues earned as a result of offering that warranty. Okay, which essentially means that if 1,000 units are sold in December, and 5% of those units are expected to be coming back in warranty, the 1,000 units times 5%, we expect 50 units that were sold to be returned under warranty for repair. They estimate that warranty costs are roughly $90 per unit. So if I multiply the 50 units by 90, the total amount of warranty costs that we expect as a result of the 1,000 units sold is $4,500. That means we need to record an expense of $4,500 to record the expense incurred in order to help earn those revenues, along with a liability, $4,500, and we credit the liability to increase it. Essentially what we have done is recorded revenues in December for 1,000 units sold. We also, throughout the month, we're recording all of the other operating costs, but we are also recording an additional expense incurred to help earn those revenues of $4,500 for the warranty that was offered. The liability means that sometime over the next year, because this is a 1-year liability, sometime over the next year that liability will be paid off, so it's current or short term. Okay, the next problem that we work with is related to notes payable. This is another current or short-term liability. Very similar to the difference between notes receivable and accounts receivable. Remember, notes receivable and accounts receivable are both amounts owed to the company by others. The difference between accounts receivable and notes receivable was a promissory note. Notes receivable have a promissory note stating that they will not only pay back the amount owed, but they will also pay interest. The same holds true for the difference between notes payable and accounts payable. Accounts payable represent amounts or a liability the company has to pay others what they owe, whereas a notes payable is the same thing, amounts that the company owes to others. But in addition to the amount owed, there's a promissory note signed stating that interest will be paid. Okay. So this problem is going to have us working with the accounting for notes payable. All of these notes payables we're going to work with are short term because they are all issued and paid within 1 year. Okay. So these are transactions for Blanco Company. Blanco prepares their financial statements quarterly or every 3 months. First things first, on January 2nd, they purchased inventory on account from Nunez, $30,000. The terms were 210 net 30. If we pay within 10 days, a 2% discount can be taken. If not, the net amount is due in 30. The perpetual inventory system means that the inventory records are updated immediately or perpetually with every transaction. So this is simply a purchase of inventory on general credit. They didn't say anything about a note payable. So we debit inventory to increase the inventory asset account, and we credit accounts payable, the liability, to increase the liability. A month later, that account payable is due. 30 days have passed. We didn't pay within 10, and we haven't paid within 30. So because Blanco is not ready to pay the $30,000 to Nunez, Blanco approached Nunez and said, hey, I can't pay you quite yet. Will you take a 9% 2-month $30,000 note in payment of our account payable? Nunez is going to jump on this, and they're going to say yes, because that means Nunez is not only going to be paid the $30,000 they're owed, but they are also going to be paid interest for 2 months. Essentially what has happened on February 1st is we have paid off the account payable by issuing a note payable. So in the general ledger, we would need to decrease accounts payable, debit the account payable liability, decreasing, and we credit notes payable, increasing the liability for the new liability. Here we're just updating the general ledger to show that the liabilities have been changed from an account payable to a note payable. On March 31st, we accrued interest for 2 months on the Nunez note. Remember that this company prepares financial statements quarterly, so every 3 months. It is now the end of the first quarter. They're getting ready to prepare the income statement, statement of owner's equity, and the balance sheet. Because interest has been incurred, interest has accrued, but it hasn't been recorded. Since February 1st, 2 months worth of interest has accrued as of the end of March. All of February's interest and all of March interest. The note is a 2-month note, which means it was issued on February 1st. It will be paid on April 1st. On March 31st, we have to record the interest that has accrued or been incurred, so that all of the interest expense for that quarter that was incurred in that quarter is recorded within that quarter. Okay, so accrued interest for 2 months. The amount of interest that we need to accrue is calculated by taking the face amount of the note times the stated interest rate. And if I stopped calculating there, I would be recording interest for an entire year, because that interest rate is an annual amount. I am only recording interest for a 2-month period. So I need to take that annual interest, 30,000 times 9%, and multiply it by the fraction of the year, or 2 months out of 12 months, 2/12. Doing the math, I calculate interest of $450. So I record the interest expense of $450, and that expense will be paid on April 1st when I pay off the note. So I also need to record a liability to pay that interest expense. So I will debit the expense, credit the liability. I am simply recording an expense incurred that hasn't yet been paid, and recording a liability. So then the next day, when the note is paid off, the company needs to pay 2 things. They need to pay not only the note payable, it is now due, but they also need to pay the interest liability as well. So we will debit both of those liabilities to record both of them being paid off, and credit cash for the amount of cash paid to pay off the liability. The next thing that occurred is on July 1st, purchased equipment from an equipment company, paying $11,000 in cash, and signing a 10% 3-month $60,000 note. Bought equipment for a total of $71,000, 11 in cash, and signed a note for $60,000. We will debit the equipment account for $71,000, credit cash for the $11,000 paid, and record the liability, the notes payable of $60,000. One thing I want to highlight. Notice that on the date that the notes are issued, no expense for interest is recorded, because interest expense does not start to accrue, or interest expense is not incurred until starting the day after the note is issued. Okay. All right, that was July 1st. It is a 3-month note, which means it will be paid off at the end of October, after 3 full months have passed. However, it is now the end of the next quarter. It is September 30th. We need to accrue interest for 3 months on that note. We need to accrue the interest that has been incurred. To calculate the interest, we take the face amount of the note times the stated interest rate times the fraction of the year. The amount of interest expense will be $60,000 times 10% times 3/12, or $1,500. Debiting the interest expense, and that interest will be paid on October 1st when the note is paid off, so we credit the interest payable. On October 1st, that Marson note is paid off. It's a short-term note because it was issued and paid all within 3 months, shorter than 1 year. The amount that will be paid off is the note payable liability plus the interest payable liability, debiting both those liabilities, and total cash paid to pay off those liabilities, $61,500. All right, it looks like the next thing is the company borrowed $24,000 from Payable Bank by issuing a 3-month, 8% note with a face value of $24,000. We borrowed cash, so cash went up $24,000, and we have a promissory note signed. We have a liability. We record an increase to our notes payable for $24,000. That is a 3-month note, which means it will not be paid off until February 1st of the next accounting period. But at the end of the current accounting period, the last quarter of the year, we need to make sure we record the interest expense incurred since that note was issued prior to the end of the accounting period. So we will debit the interest expense and credit interest payable. To calculate the amount, we will multiply the face amount of the note times the stated interest rate times the fraction of the year. Debit interest expense to record the expense incurred, and credit interest payable for the liability. If we were to now post all of those entries into the accounts affecting just the notes payable, interest payable, and interest expense. If I were to post all of those debits and credits that affected those accounts, I could calculate the ending balances in my 2 liability accounts and the amount of interest expense. The 2 liabilities would be reported on the balance sheet as current liabilities, and the interest expense would be recorded and reported on the income statement as an expense. All right, hopefully that all makes sense. There is a second video that works with the payroll liabilities.